If you bought your home in California 15 or 20 years ago, there's a good chance it's worth 2 or 3 times what you paid. That sounds like great news, but if you sell that home, gift it to your kids, and leave it to them without understanding the tax rules, one wrong move could create a tax bill your family never expected. 2 rules matter here: the step-up in basis and California Proposition 19. By the end of this video, I will show you how both work, the mistake families often make, and what to review before making any decision with your home. Hi, I'm Marybell C. I help families here in Pomona and throughout Southern California understand the tax side of decisions involving their money, property, and legacy. This video is general education information. Your exact tax and estate planning situation should be reviewed with the right professionals before you make a transfer. Let's start with basis. Basically, the number used to help calculate your gain when you sell an asset. For a home, it often starts with what you paid, then just adjusted for certain improvements and other items. Imagine you bought a Pomona home in 1995 for $150,000. Today, it's worth $700,000. That's $550,000 of appreciation. If it has been your primary residence and you meet the rules, you may qualify to exclude up to $250,000 of gain if you're single, or up to $500,000 if you're married filing jointly. But what happens if your children inherit the home instead? This is where step-up in basis becomes extremely important. Generally, when someone inherits property after a person passes away, the basis is adjusted to property's fair market value at the date of death. Using the same example, you bought the home for $150,000 and it's worth $700,000 when you pass away. If your children inherit it with a basis around $700,000 and sell it shortly afterward for around $700,000, there may be little or no capital gain from the appreciation that happened during your lifetime. Now compare that to this. I'll just put the house in my child's name for now. Be careful. When property is gifted during your lifetime, the recipient generally receives the donor's basis for calculating a gain. That could leave your child tied to that old $150,000 basis instead of receiving a new basis around the value at inheritance. That's why you should not add someone to a deed just because it sounds simple. Now let's separate capital gains from property taxes. The step-up in basis deals with income tax basis. Proposition 19 deals with California property tax reassessment. Many parents assume they can leave a home to their children and the children will automatically keep the parents' low property tax assessment. That is no longer automatic. For a qualifying parent to child transfer under Prop 19, the home generally must have been the parent's principal residence. At least one eligible child must make it to their principal residence and apply for homeowners or disabled veterans exemption within 1 year. If the child does not use it as a principal residence, the property can be reassessed. There is also a value limit. People often call it the $1 million prop rule, but the amount is adjusted for transfers from February 16, 2025 through February 15, 2027. The added exclusion amount is just about over $1 million above the home's factored base year value. The key point is simple. Do not assume your child will automatically inherit your property tax bill. Prop 19 can also help certain homeowners who want to move. If you're 55 or older, severely and permanently disabled, or qualify after certain wildfires or natural disasters situations, you may be able to transfer your property tax base to a replacement primary residence anywhere in California. For homeowners who are 55 or older or severely disabled, this can generally be used up to 3 times. So if you're staying in a home that no longer fits your life because you're afraid your property taxes will jump up when you move, review this before making your decision. The biggest mistake is making the real estate decision first and asking the tax question second. Don't automatically add your children to the deed, don't automatically gift the house, and don't assume a living trust by itself fixes every tax issue. A living trust can be an important part of an estate plan, but you still need to understand how the property is owned, how it will transfer, and how the tax consequences may be. Ideally, your tax professional and estate planning attorney should be looking at the same picture before paperwork gets signed. Here's the bottom line. If your California home has grown from $150,000 to $700,000 or more, you're dealing with one of the biggest family assets. The difference between gifting, selling, inheriting, and transferring that property can affect capital gains, property taxes, and what your actual children receive. If you own a home in Pomona and Inland Empire or anywhere in Southern California and you're thinking about selling, downsizing, gifting your home, or leaving it to your children, don't guess. Use the link below to schedule a strategy consultation with our offices so we can review your situation before you make that move. If this video helps you, like it, subscribe, and share it with a family member who owns property in California, because when you spend decades building your equity in your home, the best time to understand the rules is before the paperwork is signed.